Most people think the bond market is boring, stocks are exciting, crypto is dramatic, real estate is emotional, but bonds? Bonds sound like something for governments, banks, and old investors. And that is exactly why most people miss the danger, because the bond market is not just another market. It is the foundation of the financial system. It affects mortgage rates, credit card rates, government borrowing, bank balance sheets, pensions, and the value of almost every asset in the world. When the bond market shakes, everything shakes. And quietly, hedge funds have become some of the most powerful players inside it. To understand why this matters, you need to understand one basic idea. Governments borrow money by selling bonds. In the United States, those bonds are treasuries. In the United Kingdom, they are gilts. In other countries, they have different names, but the idea is the same. Investors lend money to the government pays interest, the bond trades in the market. Because these bonds are considered safe, they become the backbone of the financial system. Banks use them, pension funds hold them, central banks monitor them, traders build strategies around them, but hedge funds do something more aggressive. They use leverage. Leverage means borrowing money to make a trade bigger than your actual capital. And one of the most watched strategies is called the basis trade. The details can get technical, but the simple version is this. A hedge fund tries to profit from a tiny price difference between a government bond and a related futures contract. The profit on each trade may be small, so to make it worthwhile, the fund uses a huge amount of borrowed money. That works as long as markets behave normally. But if bond prices move suddenly, funding gets tight, or lenders demand more collateral, that small trade can become a big problem. The fund may be forced to sell bonds quickly. If many funds do the same thing at the same time, the selling pressure can make the market even more unstable. That is how a strategy designed to profit from tiny gaps can create major stress. This is why regulators are worried, not because hedge funds are evil, but because leveraged players can turn small market moves into large shocks. And when those shocks happen in government bond markets, they do not stay on Wall Street. They move into the real economy. Mortgage rates can rise. Government borrowing costs can jump. Pension funds can come under pressure. Banks can face losses. Businesses can find loans more expensive. A bond market problem becomes an everyday money problem. The strange part is that hedge funds are not the official managers of the bond market. They are not elected. They are not central banks. They are not public institutions. But through leverage and trading size, they can become major sources of liquidity when markets are calm and major sources of instability when markets panic. That is the dangerous trade-off. In good times, hedge funds help markets function. They buy, sell, arbitrage, and provide liquidity. In bad times, they may pull back or unwind trades quickly. The same players that make the system smoother can also make the crash sharper. This creates a bigger question. Who really controls the price of government debt? Governments issue it, central banks influence it, but markets price it. And if highly leveraged hedge funds dominate parts of that pricing system, then public finance becomes connected to private risk-taking. That should concern everyone, because governments today are already carrying huge debts. When debt is high, bond markets matter even more. If investors demand higher yields, governments pay more interest. If governments pay more interest, budgets get tighter. That can mean higher taxes, lower spending, or more borrowing. So when bond markets become fragile, the consequences can be political, economic, and personal. This is not theory. We have already seen moments where bond markets moved violently enough to force central banks to step in. When that happens, it sends a clear message. The financial plumbing is more fragile than people thought, and hedge fund leverage is one of the hidden pipes. The public usually notices only the final effect. A mortgage rate jumps, a pension headline appears, a government announces spending cuts, a central bank holds an emergency meeting, but behind the scenes, the story may begin with leveraged trades, collateral calls, repo markets, and forced selling. That is why the bond market deserves attention. It is where boring becomes dangerous. So what should normal viewers take from this? First, do not ignore bonds just because they sound dull. Bond markets set the price of money. Second, understand that leverage is powerful but fragile. It can make small profits big, but it can also make small losses dangerous. Third, when government debt is high, Financial stability depends on trust. If bond investors lose confidence, the cost can reach households quickly. Fourth, remember that the biggest risks often live in places the public does not watch. A stock crash is visible. A crypto crash is viral. A bond market liquidity crisis is quieter, but it can be far more important. The uncomfortable truth is this: the world's safest markets are not always as safe as they look. They are filled with trades, borrowing, assumptions, and institutions that depend on calm conditions. When calm breaks, everyone discovers who was over-leveraged. And if the answer is too many hedge funds inside the bond market, the shock may not stay contained. The bond market may look boring, but boring is where the system hides its biggest risks. If this video helped you understand the hidden power of hedge funds in the bond market, subscribe to the channel for more clear and honest finance breakdowns. Thanks for watching.